As long as the lender is basing their metrics, their decision for the loan on gross income,
Right.
as opposed to adjusted gross income. Because if they're basing on adjusted gross income, then it's going to be backed out. It'll be lower by the amount of the tips that they're able to get a deduction for. Just want to point out, there's still going to be the payroll taxes, the employment type taxes on those tips. There's no exclusion for that. So there'll still be Social Security tax, state, local, and unemployment tax on those tips.
Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. Today, my guest is Brian Perpiglia from Perpiglia and Company. You're a CPA,
yes,
and we're going to be talking taxes. Tax season is right around the corner. Well, welcome to the show.
Thank you. Thank you for the invitation. Much appreciated.
Great. Okay, so we're going to be talking about some of the changes because they passed new legislation, the Big Beautiful Bill, and there is definitely some changes as far as deductions and everything else.
Yep.
So why don't we go, first question I have for you, the tax rates. Did they stay about the same?
Rates are the same, and as usual, the brackets themselves,
Okay.
which usually they're about $50,000 each particular bracket, and only the amounts inside that bracket are taxed at that rate. The
Right.
rest is still taxed at the lower rate. They're indexed each year as they are, so no real big change there.
Not big, okay, but every year it goes up just slightly,
A little
right?
bit, right. Mostly tied into inflation.
Perfect. Okay, so that is pretty much the same. Now, so what are some of the biggies? Because I know we have no tax on tips, we have overtime, we have the senior deduction, we have depreciation, we have a bunch of stuff, and then some tips as far as if you're a 1099, because people get caught up with taxes as far as that's concerned, and so on and so on. So why don't we start off with
Well, on the individual side, there's four new deductions.
okay.
First one I think that got the most press is the tip deduction.
Okay.
Yeah, it's not an exclusion of income from tips, of tips from income. It's just a deduction on the tax return. So it's a deduction going from your gross income down to your adjusted gross income. So your W-2 will not change. Now, that the employer is not going to do anything different this year than in past years if you're a tipped employee. There's 8 specific industries that qualify that count as qualified tips. But for the most part, if you're in the food industry or the concierge industry, any kind of service industry, you're going to qualify for it. And it's only on tips that are on your W-2 or 1099. We'll get to that, and we'll get to that too as well. But there's a separate line, of course, on the W-2 for tips. It's box 7 on your W-2. So your employer is not going to do anything different, but there'll be a deduction of up to $25,000 of tips that are reported on your W-2.
Okay. Okay, so now let me ask you this question, because for me as a lender who lends money and somebody who is, let's say, a bartender or a waiter or waitress, whatever, typically they try to show as little money as possible because they don't want to pay the government. So in theory, somebody could claim $25,000 more, tell the employee, hey, show $25,000 and not have to pay, because now they have that deduction of $25,000, right?
That's right.
And then they could qualify potentially for a house if they didn't qualify from before, right? Because that would being a real estate show, that's what we would look at.
As long as the lender is basing their metrics, their decision for the loan on gross income, as opposed to adjusted gross income. Because if they're basing on adjusted gross income, then it's going to be backed out. It'll be lower by the amount of the tax that tips that they're able to get a deduction for. But just want to point out, there's still going to be the payroll taxes, the employment type taxes on those tips. There's no exclusion for that. So there'll still be Social Security tax, state, local, and unemployment tax on those tips. But it's good for the industry. I did not think that would pass, but it did pass.
Right.
I think there could be some backlash, maybe from other areas of the workforce
Right.
who now see certain industries getting tax-free or a tax deduction. They're going to want it as well.
Right,
So
right. Yeah, but
could be flooded with that. I don't know.
right, but a lot of the service industry, may make a little less money than other sectors. So, do I want to take less money or do I want to make more money? It just depends. I get that.
When people see their next door neighbor getting a break, they want it too. That's
They
human
want it.
nature.
Yeah. Okay. So what are the income? Like, doesn't it phase out?
Yeah, first off, for the tip deduction, which is the first of the new deductions, it is $25,000 as a deduction, and of course, it's capped at whatever tips you show. You naturally
Right.
can't get a deduction for more tips that are on your W-2. The phase out is going to be, I believe it's $75,000 for a single filer, and $150,000 of adjusted gross income for a joint couple, a couple filing a joint
Right.
tax return.
Okay.
It's not available if you're married under the state law and you choose to file separate returns. The tip deduction is not going to be available.
Right, and that makes sense because they want to make sure that you're under the $150,000. So if you're filing separately, then
It could be a way to usurp that. Sure.
exactly, absolutely. Okay, so that's one. How about overtime?
Overtime
that had a lot of play too.
is a new deduction as well. What is deductible, of course, is just like as the tips, where it's defined as qualified tips, is defined as qualified overtime. Now, overtime, of course, is time and a half, and it is the half part that's deductible. So just as an example, if someone worked overtime and their normal pay was $200 for that overtime, whereas they're now going to get $300, time
Right.
and a half. The $100 is considered qualified overtime.
Right, up to 25,000.
Up to 25,000, correct. Now, also too, now that of course has not been placed on a W-2 in previous years. There was no need to. It's just lumped in as regular pay.
Right.
So now this year, in terms of the IRS being on the ground and doing the metrics to have this deduction, it's not mandatory now that employers place your qualified overtime on the W-2. For our clients, we're doing it that have it. We're putting it in box 14 and coding it either OT, which is what you can do. But in 26, if the law's still around, if the deduction's still available, employers are going to have to place it on the W-2. It's mandated now by the
So this year coming up, 2025, they don't have to do it, but next year
That's right. So the best way to do it, if you're an individual and you think you're eligible for the deduction, would be to have your pay stub. Hopefully
Right.
they're listed on the pay stub, or get some records from your employer. If it's not listed on your pay stub, just do the best you can to have the number.
Okay.
But next year it's mandatory that employers place it on the W-2, because otherwise right now it's just lumped into your box 1.
No, 100%.
Wages, taxes, and tips. Sure.
Okay. And now, and that's 150,000 as well, or for the income
Phase,
limit?
it's
phase out.
150. Actually, I think it's a little higher. I think it's 150 for unmarried and 300 for married.
Okay, so that's a little higher. Okay, great. Okay, and then
Yeah, but a couple, just
Go ahead.
as with the tip deduction, Pennsylvania is not acknowledging that as well. So there's no tip deduction on Pennsylvania taxes. But at the W-2 level, that shouldn't really cause a larger balance due on your Pennsylvania return, because the tax will be withheld at the employer level.
right.
And
Okay.
Pennsylvania is a flat rate. There's no progressivity in the rates in Pennsylvania.
Right, so this is
3%.
the federal part, your state and city tax, that kind of thing. They're not signing up for that, Okay, I got it. Okay, that's interesting. And then you have the senior credit.
Yes, it's available.
And then you mentioned with that, we had a conversation earlier that there's some really interesting financial planning you can do with that. So elaborate on that one.
Now, the senior credit is the third of the new deductions. It's not credit, it's a deduction. Now, what this is it's a little different. The tip and the overtime deduction are deductions to get down to adjusted gross income. This
Right.
is after adjusted gross income. And the good news is this is in addition to your standard deduction, which is great.
Right.
So you could have a situation where if you have a married couple and they're both seniors. Now, seniors is defined as being at least 65 years old at the end of the tax year. So
Okay, so let me understand. Not that I'm retired at 62. You have to be 65 65.
65.
Okay, great.
It's not just you're retired.
Right.
So, and the test is always as of the last day of the year. So if you're over 65 on the last day of the year, you're eligible for this deduction, which is good. So the planning opportunity I wanted to mention is that a married couple, if they're both over 65, they have a basic standard deduction of $32,000. They're going to get an additional, I'm rounding, $3,000, which has always been around just for being over 65.
Right.
That gets it up to 35. And now this new senior deduction of $12,000, $6,000 each. So you now have a standard deduction of $47,000.
Right.
So if you're sitting on some gains in a stock portfolio, or you want to take some money out of a retirement plan, there's a great opportunity there to take it out and have it eaten up by the standard deductions.
Right.
Meaning you'll pay no tax on it.
Right. And these all phase out in 2028. So
yeah, these three we mentioned
Right.
thus far are right now legislated to expire through the 2020 December 31st of 28. So through the 2028 tax return.
Okay, so what that means is if I have money in a 401k, I could plan to potentially whatever your tax brackets are, or your income levels are, to be maybe take 20,000,
Yeah.
20,000, 20,000. So you're going to take 60,000 out, where because you have
The standard deduction to eat it up. Yeah.
to eat it up with the enhancement of that $12,000. Right. So
You just have to be a little careful, because the more you take out, it could cause more of the Social Security benefits you are receiving to be taxable. Social Security becomes taxable if you have a certain amount of other income.
Right.
So if you take too much out of a retirement plan, or you recognize too much capital gains, then it may cause more of your Social Security to be taxable. Even if you went over your standard deduction a little bit, you're only in the lowest bracket anyway, 10%.
Right.
You're not automatically into a higher bracket.
Right.
You're only at the 10% bracket.
Right.
So it's still good value.
Absolutely. And then I think that at a certain age, you can make as much money as you want, and it doesn't impact your Social Security income.
Right. Earned income.
Right,
There
right.
is that rule out there. If you are right now, full retirement age is 67.
Okay.
But you're eligible to collect Social Security at 62.
Right.
And I'm a big fan of collecting at 62 if you're not going to run afoul of the earnings cap. Now, the earnings cap is right now 24,000, but that's of earned income.
Right.
W-2, 1099 type income, active income. It doesn't count pension or capital gains or interest income, rental income, things like that.
Right.
So if someone makes, and it goes up a little bit each year. If someone makes more than 24,000 and they're collecting Social Security, but they're not yet at full retirement age, then the Social Security Administration will take out from their check $1 for every $2 they're over. So if someone makes $30,000 per year and they're collecting and they're not at full retirement age, then that is $6,000 over the limit. They will take $3,000 out of their monthly check.
Right, and that's what you have to watch out.
Yeah, just got to be careful of that. It's a rule. It's a silly rule.
Right.
But I think it's silly, but it's a rule. But then right now, after 67, for people in that bracket right now, there's no more earnings cap. But always do an analysis for Social Security. I'm a big fan of taking it at 62. If there's no earnings cap, I would take it at 62. Every example I've seen, the analysis is you look at what you're going to forego if you want to wait 5 years.
Right,
If you're going to get $2,000 a month, that's $24,000 a year. That's $120,000 over a 5-year period. You'd be foregoing for the privilege of maybe getting an extra $300 a month.
Right.
If you wait till full retirement age. I mean, that could be a 20-year recoupment.
Right.
To give up all that money.
And the big thing is also health. Like if
Yes.
you're super healthy, everything, well then maybe say, okay, maybe I'll wait a little bit.
You have
but if there's anything at all, yeah, that
You have
makes
to
sense.
factor in the just you never know factor.
Exactly.
That's
I got
what you
hit
have to
across the
factor
street
in.
and I got hit by a bus.
That's it. She could do things with that money. So
Absolutely.
you're going to really, if someone's at a high earning point and they're going to stay there,
Right.
I would not open up. You'll just give back too much. It wouldn't be worth it. But I always like to look at the recovery time of what you're giving up for the privilege of getting an extra whatever.
Right.
Yeah, but you can get your numbers very easy from the Social Security Administration. It's just the way you have the information to make the decision.
Okay, and then now there's bonus depreciation. It's part of the bill as well. So can you talk about a little bit of that, because that really goes, ties into a lot of real estate as well, because now you can, I guess, do improvements, but elaborate.
Well, the main thing that bonus depreciation did, because it had been getting eaten away, was at 60%. Now you could do 100% of qualified property. Again, things have to be qualified, just like the tips and the overtime. Now, it's a pretty broad definition, a little bit better than the Section 179 expense deduction, which is similar in nature, but bonus offers some more items. You could do it on improvements to real estate, whereas you couldn't do for Section 179. But the life expectancy itself has to be less than 20 years.
Right.
So a building itself would not qualify for bonus depreciation.
But the equipment, the improvement,
definitely the equipment and even interior products, if it doesn't become substantially part of the structure, that's the wording in the law, you're going to qualify for the bonus depreciation, which is good, and it's going to stir a lot of people, spending and buying and getting a full deduction for it, as opposed to writing it off over a 10 or 15-year period.
Right, and then and how that could impact is, hey, I'm going to put $5 million in the building, like just put all new lighting, energy efficiencies, units, whatever, machinery, whatever the case may be that you're going to put in. Hey, if I was going to pay $5-10 million in taxes, I'll depreciate the whole amount, and instead of giving it to the government, I can put it. I have an opportunity to fix my building to make it more efficient, make me more productive, so I can make more money in the future, right?
It does lower the businesses, your company's taxable income immediately, right? Right. So, but $1 million bonus depreciation deduction won't lower your tax by $1 million, it just lowers your taxable income by $1 million. And there is a cap on it, but it's a good size cap.
Right.
It's a good size cap. I forgot what it was, but it's a good size cap.
Right, and that's the thing. That's part of what the bill's trying to do is to encourage investment. So, hey, if I'm outfitting, I'm buying equipment, I'm doing whatever, that's increasing jobs potentially.
Government has done that, with accelerated depreciation, it's done that. Years ago, there was something called an investment tax credit, where if you bought equipment, business equipment, you got a credit for it as opposed to a depreciation deduction. So it's always been around. Congress has always chosen to use the tax code for certain things.
Right.
You get a deduction for charitable contributions if you itemize. It wants to stir giving from the people.
Right.
It relieves them of the obligation of funding some charities. So it's good to use the Internal Revenue Code like that. But then they've done some nice things.
Right, and it's super smart. You're a CPA, you're not giving advice to a specific person because you really need to, dig into the books and figure out what can be done, what can't be done. But hey, definitely sit down with your accountant, your CPA to figure out, hey, what advantages can I take to minimize, and then also just to make my overall production potentially and additional revenue potentially coming in, how can that be a win-win situation, right?
And remember, the bonus depreciation, nor anything in the big, beautiful bill, did not usurp the rule that to have something available for depreciation, it has to be placed in service. So you have to have it ready to go. Not on order, not being delivered 3 months from now. You have to have it, and it has to be placed in service.
Which makes sense, too, because now they want you to order the equipment.
They want it ordered, delivered, and paid for.
Right, exactly.
Then you can write it off.
Exactly, and then that way,
absolutely, yes.
It's actually in service.
Yeah.
It's actually.
So that didn't change under any act, and Congress has never changed that. That's always been one of the bedrock principles of when something is eligible for depreciation. It has to be placed in service.
Right.
And then you just determine what the applicable life is. If it's for equipment and tangible personal property, it's a quicker life. It's either a 3-year or 5-year, 7 years for furniture. And more structural stuff is 15 years, and 27 for residential real estate, and 39 years for commercial real estate.
Okay, and then potentially, if you have like Airbnbs, things like that, you may be able to utilize some of this as well.
Yes, exactly.
Perfect. Okay, so a lot of people who listen, maybe realtors, maybe loan officers, maybe just in the real estate industry, period. And a lot of these people are 1099 employees. So what advice do you have for them? Because a lot of people get caught where they don't set the money aside, and now all of a sudden they have a tax bill, on there. I know some people that turn around every time they get paid, they get a commission check. They turn around, they have a separate account, and they put $300 in that account, or $400, whatever. So at the end of the year, they may have $10,000, $20,000 in an account, so they have that fund to it. But you mentioned that which I didn't think about this, you can make payments directly to the IRS, right? So explain that.
You have two choices. You can set up an account with the IRS. It's a little involved. It'll probably take about a half hour to 45 minutes to do. You have to upload certain documents with personal information on it, which makes some people a little bit leery about it. You have to upload a selfie of yourself, your driver's license, and I think a phone bill, because they have access to that. They'll tap in it just to make sure it's you. And then you'll have an account. You can make payments electronically. But the law mandates your estimated payments are required quarterly, but you're certainly not limited to that. You're not prohibited from making it more frequently. I always like to tell people if they're being paid as a 1099, perhaps maybe they should be a W-2, but the employer for whatever reason is not doing that. Treat yourself like a W-2, right? Whereas your employer would normally withhold your money from your check and they flip it over to the government, just write a check yourself every week. Every week you get it this way. You're making yourself a W-2. I always like to tell people 15% for on the federal side, 15% for Social Security tax, and 10%, at least 10% for income tax. So whatever your gross pay is, I would cut a check every week for 25% of that right to the Internal Revenue Service for federal tax, and Pennsylvania's rate is 3%, 3.07 to be exact, and a similar check to the state of Pennsylvania if you're a Pennsylvania resident. Right. It's always a good thing. You always want to have that paid. And some accounts will tell you, always owe the government money. Try to just avoid a penalty paying a minimum account. I'm not in that camp. Right. I always like to have enough built in to get a refund. Yes, you're getting your own money back. I understand that. Right. And the government's holding your money, but you know what? You can't spend it, and your taxes are covered. If God forbid something happens where you might not have the money, and April 15th passes, even if you file a return and you don't pay, there's still interest and there's late payment penalties, and they're pretty heavy. Right, and even if you pay a little bit more into that account that you set up, you get a tax refund, just like that. Exactly. Roll it to next year. Exactly. Just like not money thrown away. Any W-2 employee that, hey, I got a $5,000 tax refund. Yeah, that's right. You're getting your own money back, but it's nice to get a refund. And some people, they could do something big with it, whereas that extra $50 a week, it's just going to get eaten up. 100%. You figure out a way to spend it. Yeah, that's right. You'll figure it out. Just with life. That's right. Yep. That's right. So it's much better. I'm in the camp of always building enough in to have a refund coming. Absolutely. And one more thing I want to mention: 10 people paid as a 1099, almost like delivery people. Whether it's pizza place or even an Uber or one of the delivery services, a DoorDash. You're eligible for the tip deduction as well. Right. Okay. But your tips have to be set. You have to be able to document how much were tips. Now, but you mentioned with the tips, it has to come through the employer. Like, what happens if somebody directly pays you tips? You just can't claim. Well, if you have records and you are including it in income, you can do it. That's right. But if somebody gives you cash, hey, I dropped somebody off, they hand me $5. How do I show? Well, you would just have to include it in your gross. Okay. In your gross, it might not be on the 1099, but you can include it. You include it in your gross income. Just like now, even before the tip deduction was available, if someone paid you extra, you're required to include that in your income. But the tip deduction you take if you're a self-employed individual cannot exceed the net profit you show from your 1099. Because remember, when you're a 1099, you can deduct expenses that are directly related to that, as long as you can document them. Right. As long as you can document those expenses, you're entitled to deduct. That's one of the upsides of being treated as a 1099. Right. If it's the expenses directly related to the business and you can document it, you can offset it, and it lowers the amount of tax that you do pay. Yeah, because the first round, when the Trump administration was in, they took away the reimbursed business expense if you're a W-2. If you're an employee, correct. That's exactly right. Yeah. That's gone. That's been going. That was in 2016 to 2000. Exactly. Yeah. Yep. Yeah, that was gone. Okay. So, is there anything else people should know or ask their accountant? This year, as far as any kind of financial planning, or even for next year, or what kind of deductions they should be looking out for? Well,
that they could possibly, fit into?
I think the first thing you should do is try to have your documents early. Now, my office, our policy is we have to have someone's documents by March 20th. After March 20th, we're in extension mode.
Okay.
But just for individuals, even individuals that are going to do the return by themselves, always, if you can't get your return done before the April 15th deadline, always file an extension. Very important, particularly if you think you're going to owe money. And if you can pay money with your extension, that's great. You'll lower the interest. But even if you cannot pay anything, file the extension. You could go right on irs.gov and do it, or download a form 4868. That's the individual form. That's important because if you file a tax return and you owe money, there's three potential whammies. The first one is a late filing penalty, second is interest, and the third is a late payment penalty. And believe it or not, the most onerous of the penalties is the late filing penalty. And you could eliminate that automatically just with an extension. No money, just with an extension. The interest and the late payment penalties, they're a little bit onerous, but not nearly as onerous as the late filing penalty. So the thing I try to stress to people, always file an extension. I mean, if it's a client of ours, we're going to do the extension electronically, but you can still mail an extension. Some people don't like information in the cyber world out there. I still have some people who want to mail in their returns.
Right.
And they don't. They just don't want to file electronically, and that's fine. The IRS was jammed up with paper returns during COVID because they couldn't get their people in to process returns. It wasn't their fault. Just like other employers, they couldn't have a full crew. And then it really got backed up when they were allowed in on a limited basis, and the paper filings got backed up. But the IRS processing paper returns has gotten back to where it was. It's very good.
Okay.
It's very good.
So the last one I have for you, and we ended as far as the car deduction.
Car deduction. Okay.
So what is the story with that? And then you mentioned in our earlier conversation that there's a website and all that.
Actually, you can check the VIN. Okay.
Yeah.
This is the fourth of the deductions, the big new deductions. The tip deduction, the overtime pay deduction, the senior deduction, now the car credit. A couple of requirements. The first one is it has to be a car purchased, not leased. Leases or used cars don't qualify for the car loan deduction. So it can't be a lease, has to be a car loan. The car has to have a final assembly in America, in the United States. And there is the website. If you could just Google, I wrote it down, but I did forget to bring it.
We'll post it. Don't worry about it. We'll post it on the website.
It will tell you, if you punch in your VIN, it'll tell you if your car qualifies for it.
Okay, so that's super important. If you're going to buy a car and you want that deduction, you go onto the website.
Yes.
You plug that in and make sure it's going to work.
Even before you buy the car. Just ask for the VIN and plug it, punch in.
Or I'm sure they can do that at the dealership too.
Mm-hmm.
I'm sure they have that like that in the dealership.
Mm-hmm.
Absolutely.
That's right. And that's a nice deduction. It's up to $10,000 of interest.
Right.
So it's a good deduction. Mm-hmm.
Okay, and then the last thing that we talked about was, some of these companies that negotiate, if you owe back taxes and everything, that you said you had some clients that had good experiences, some had bad experience, what is that?
Unfortunately, a lot of people are jammed up with federal taxes, and state too, but for the most part, when I see situations, it's usually the IRS. The notices come and they're upsetting.
Right.
You get notices. But
you're afraid. It's frightening.
A lot of times, because the IRS has a lot of taxpayers to administer to, notices don't come as frequently. And sometimes there's this false sense of security. Oh, well, things must be fine. I haven't gotten a notice in 3 months. But it's not. It doesn't go away. And unfortunately, there's companies out there that try to take advantage of people who have anxiety over the situation.
Right.
And they kind of promote the impression that, and I guess it's fostered by the internet age where we expect things to happen in an instant.
Right.
But satisfying your debt doesn't happen in interest, and it can't. So when someone says, we're going to get it done quickly, that's not true. That's not the case.
Right. You see some of these commercials. Hey, I owed $80,000. Now I have to pay
they're out there. They're on television, radio, and particularly on the internet, of course. All these testimonials, but a lot of them are, to use a term of the day, bad actors, and they'll take money up front and not really do much at all. So you're not going to get your situation taken care of immediately, but you can relieve anxiety immediately. First off, you have to determine what the cause of the balance due was. It could be under withholding, could be you just weren't making enough estimated payments, if you're treated as a 1099, and you have to change that. You have to change that. You have to show, eventually, you're going to ask the IRS either to compromise the tax or abate some penalty, which the IRS has authority to. IRS can't abate interest. They have no authority to abate interest. But I always tell people you have to lay the groundwork. You have to turn your situation around. You have to show the Internal Revenue Service why they should give you a break.
Right.
If you're going to continue to be under withheld and you're not changing that, you're not curing the situation, they're not going to give you a break. Why would they?
Right.
Why would they? You're going to keep doing the same thing. And then eventually, if you keep doing it and you don't pay, they're not going to set up a payment plan with you. And they can force your employer to withhold more money.
Right.
If they want to. But you got to cure the situation first the best you can. Now, I mentioned you can relieve the anxiety. I like having appointments with the IRS, and I've gone down with people. I feel a lot better afterwards. You can set up a payment plan. Now, you have to make your payment once a month, but what that does, it takes the enforcement end out of it.
Right.
Out of it. So now the IRS, you'll still get monthly notices, but you won't get the threat of a levy, either your bank account or your paycheck, which is very important. That's an embarrassing situation.
Right.
If you're at work and your boss calls you in and they have this letter in their hand saying they have to levy your pay.
Right.
And they can. So just realize, just have to be in the right frame of mind. Now, offers and compromise are available. They're very hard to do. You have a much better chance of getting penalty abated, I tell people.
Right.
Especially if they're younger and they have a lot of working years left. You're not going to get it. You're certainly not going to get the discounts that some of these online advertisers promise.
Okay.
So just be careful. Just try the best you can to cure the situation of what got you into that. And then you can document it and you can show the IRS. Say, look, I'm having more withheld from my paycheck now.
Right.
Or you can see I'm making estimated payments now, and I'm going to cover. And I always like to have at least 2 years in the bank where they've changed the situation. Now they have enough paid in tax-wise, and they're getting refunds. They won't get it, of course,
Right.
but that's where you want it to go anyway. Then you could approach the IRS. Now you got credentials. Now you can say, look, I had a situation. It was a bad time for whatever reason, but I've cured it, and now you have documentation. It's always better to show the Treasury Department what you did rather than promising them to
Right.
do something. That's just like anything, not the Treasury. It could be anybody that you're asking to do something.
Right.
It's much easier to show them what you did on your own without the threat of a levy or anything than what you promised to do. Because they hear stuff like that.
They hear stories
all the time. So if you can show them what you did, it's much, much more credibility. Absolutely. Now you'll get breaks.
Right. Okay. So if somebody wanted to talk to you or find out more about your services, how would they get a hold of you?
Well, our quickest way is our phone number, 215-755-9988, or my email is my first name, Brian with an I, BRIAN, CPA01@gmail. And it's myself, it's my company, and I have 4 accountants who work for me, 4 staff.
Okay, perfect.
And it's good business.
I really appreciate you coming in because I did get a lot of questions from people saying, hey, what are the changes? And I said, you know what? Let's do a pod. Let's talk about it.
Thank
and
you
in
very
this way,
much.
people can see it. So 100%, I appreciate it. Well, that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook, Instagram, and of course, YouTube. The Real Estate Show with Pat Lopez on YouTube. Remember, we talk everything real estate. Help me get to 50,000 subscribers. I'm almost there, a little bit over 45,000. Give me some likes. Really helps out the algorithm. Hope you enjoyed the show, and I'll see you next week.